Ashwini Agarwal also joins us. Let's get a sense from Ashwini as to what is causing pain in this market. Ashwini, when markets are falling, everyone is saying it's FI liquidity which is drying up. But FI versus DI, the net liquidity is not that bad. So what is really hurting the market? Is it only election? Is it general valuation or a fear of a slowdown which was perceived now has become real in autos and consumer?
So, in my opinion, there are multiple factors. One is that if you look at January to April, across emerging markets, we saw significant inflows into the markets, and that has started to reverse in May. So the first trigger for the markets is obviously some amount of FI selling that has come in recent weeks, and that follows the trend that we are seeing elsewhere in the region. This is being triggered in turn by the trade worries and the spat between the US and China, and some worries on account of slower growth globally if these trade wars were to intensify. Closer at home, I think the worry is less on elections but more on the continuing pain of one, very short or tight liquidity in the system, which is hurting the NBFCs, and second is slow growth in demand, which is being seen in the results of all the consumer companies, and that I think follows multiple factors. We've had very little growth in farm incomes, we've had very little increase in employment. Government spending has also slowed down, which is usual at the time of elections, because the government is busy fighting the elections and a lot of the government machinery is deployed in the elections activity. So, a combination of all these factors is what is leading to a softness in the market at this point in time. I think what we really need to see is a stable government come into place, that we will know in about 7-8 days from now whether that will happen or not. And second is that the new government needs to address this tight liquidity in the system and the fear psychosis that is kind of gripping the equity and the bond markets relating to some weak hands in the system. That needs to be done on a priority basis. And last but not the least, I think RBI needs to cut rates aggressively. I would recommend by even 50 or 100 basis points.
That's a great recommendation. I only hope that the RBI does follow that. Ashwini, morning. Just going through some of the global fund managers survey, and it seems that 34% of them they've taken out protection against a very sharp fall in the equity market. So I just want to stretch upon the points that you were making. Is that nervousness around elections? I mean, or rather, how much of this nervousness is because of elections which are just now a week away?
I don't know, to be honest, because if you look at the majority opinions, they seem to indicate that the market is discounting roughly 200 odd 50 seats for the BJP. So clearly the majority does not expect a third front government or a very weak coalition government at this point in time. So yeah, there may be some people who might be taking a hedge against that outcome, but I don't think it's that. I think it's more the global worries, the trend that's happening elsewhere in emerging markets, possibility of the trade war between the US and China intensifying, and slow growth. I think what is really bothering people is the slow growth, and this growth needs to reverse. And for this growth to reverse, what we need is significant monetary stimulus, lower interest rates, and potentially the government trying to address some of the issues surrounding the NBFC sector. It's a little bit like this, right? Money is oxygen to these NBFCs, and if money is not easily available, even the firms that have adequate assets, have adequate collateral, will find it very difficult to refinance their liabilities. They will be forced to sell down their assets at deep haircuts, and where no stress exists, stress will emerge. The whole concept of a going concern needs to continue, and for that I think some serious intervention is required.
It's not that interest rates have become high suddenly. 2 years ago interest rates were low. 2 years ago there was liquidity in the system. 2 years ago NBFCs were lending, yet there were no earnings. That time everybody blamed it on GST and demonetization. We'll always find reason to figure out that, look, this is going wrong, that is what regulators should do. But the bottom line here is that valuations are high and growth is not there. And everyone's gone wrong, including me, in terms of the way we perceive the economic recovery. It's plain and simple.
So you're right in a sense, except that the causes this time around are different. Hindsight is very powerful, and like you said, that many of us got things wrong. But in hindsight, you've had 3 successive shocks to the system. The first shock was demonetization. The second shock was GST, which hurt a lot of the unorganized sector. And third shock is the tightness in the liquidity. I mean, in hindsight, again, it appears very simple that when you're administering such large changes to the way you're managing the economy, whether it is demonetization, whether it is GST, whether it is RERA, whether it's a whole bunch of other regulatory intervention, then at that point in time you need to provide a significant amount of liquidity to the system, which obviously we didn't, and we are seeing the after effects of that. Some of it is also just unfortunate. It's a timing issue, timing in the sense that ahead of elections the government spending does slow down. The government spending also slowed down towards the end of fiscal 2019 in response to very low tax collections, which the government wanted to make up for, in the sense that they cut down on spending in order to be able to report a decent fiscal deficit number. So, some of these things have come together. I think the causes that were causing the slowdown 3 years ago are different from the causes that are causing the slowdown today. But yeah, I mean, if you zoom out and say, let's forget the causes, just let's look at the valuation and the fact that there is no growth, then the market needs to sell off. I mean, you would be right, except that I would venture to argue that the causes are very different, the remedies that we need are very different, and the remedies are there. I mean, we can do it as a system, provided we have a government that is able to take some calls, and the government pays attention to this brewing crisis in the financial system. We normally don't talk about stocks, but Mr. Uday Kotak, in his opening remarks for the Q4 earnings call of Kotak Mahindra Bank, said that the financial system stress should not spill over into the real economy. That is the real challenge for the policy makers, and I couldn't agree with him more. I mean, I think that is the real risk that we are grappling with, and that is the risk I suppose some investors are trying to hedge against.
Okay, let's talk about some of the banks as well. In that scenario, Ashwini, given what you've said, and I know you've been fairly positive in terms of the earnings outlook you have through FY20, we've seen a fair amount of the heavyweights now come out with their earnings, and we have seen the gradual cleanup, especially on the PSU side. What have you made of the results till now?
So the encouraging part is that at least for the larger banks, the incremental slippage number, which to me is the indicator of the quality of their loan book, has started to come off. So whether it's the large industrial lenders or it is the large PSU banks. Obviously, some amount of cleanup still remains. Some of the PSU banks have very low coverage ratios on their loan loss provisions, so they will continue to provide heavily against these gross NPLs through 2020. So I suppose for some PSU banks, the earnings outlook needs to be moderated compared to where we were about a year ago. Here, I think one key disappointment for me personally is the lack of resolution via the insolvency and bankruptcy code. The SR issue still remains stuck in the courts. We were hoping that this gets resolved first in the December 2018 quarter, then in the March 2019 quarter, but I just don't know how long this will continue. I have no idea what the legal merits of the case are. I'm not a legal expert. But as a system, I believe that we need to move forward a little bit faster on this, and if it requires that the new government pay attention to the IBC law and make certain changes which prevents some of the abuse that's been taking place, or some of the areas which are probably grey and which are causing the delays through in the resolution process, we need to do that, because that to me is critical in bringing back some of the confidence in the financial system, especially the large banks.
What is the trigger for markets to go higher? I'm asking a simple question.
Well, if you, okay, let's lay out a roadmap. Okay, let's say that we have a strong government next week. Let's take a situation where the RBI and the Finance Ministry agree that there is a stress in the financial system and there needs to be some action that needs to be taken. RBI cuts rates by, say, 75 basis points. I'm taking the median of 50 basis to 100 basis point. And the Reserve Bank of India opens a special window for refinancing of liabilities for the healthy NBFCs. Simultaneously, the government announces some resolution plan for the ILFS with a haircut or without a haircut or whatever way it turns out to be, but a resolution. So there is a visibility that, let's say, by November or by December 2019, the ILFS problem will have been largely addressed. If these 3 or 4 things happen, suddenly you will see the animal spirits coming back, confidence in the lenders coming back, confidence in the banking system coming back, the NBFC is starting to do better. The entire activity, the outlook will look very, very different. I mean, it is possible. So, I mean, I don't think that the situation is unsurmountable. I don't think that the problems are so deep that they can't be addressed. Yes, there is a US-China trade war issue out there which we can't predict, which is a potential risk to markets, not only in India but all over the world, and we'll see how this unfolds, because we've seen, to and fro on this topic, several times over the last 2 years. We must also remember that the US goes into elections in 2020, and a significant trade war with China will slow down the US economy as well and might cause pain to the US consumers as well. So let's see what comes out of that. So I'm not willing to bet on that front. Things can go out of hand. It's 2 very powerful economies playing a game of poker, so you don't know how things turn out. But leaving that risk aside, I think the issues in India can be handled. If they are not handled, on the other hand, you have a weak government, or you have a government that refuses to acknowledge this problem, and we continue with baby steps of 25 basis points RBI rate cut in rates, then you could have a situation where the slowdown deepens over the next couple of quarters and the market comes off. I mean, we'll have to see what happens.
Okay. What if you don't get a stable government? What happens then to the market and to the economy?
Okay, if you don't have a stable government, will you have a good finance minister? That's again something that we saw back in '96, where you had a coalition government supported on the outside by the Congress, but you had a very good finance minister who took some extraordinary bold steps during that time. So to me, a weak coalition government is not a death knell. It totally depends upon who the Prime Minister is, what kind of a government it is, who is the finance minister, what role does the Reserve Bank play in the interim period between the time the government is formed and the finance ministry is in place to take some crucial decisions. What is the new budget look like? I mean, it will depend on a lot of these factors. Yeah, you may have a knee-jerk negative sell-off because the market is pricing in a BJP win. So for sure, if a coalition government were to come in place, or if there's no clear majority and there's a lot of negotiation before a government comes into place, you will have additional nervousness because that's not something which is baked into the market right now. But I think medium term, you need to look at who is running the government and what are the policy solutions they are offering.
I feel all these factors aside, in isolation, if we had an earnings recovery and a visibility also of a strong earnings recovery, the market could have been sort of isolated from all that's going on with elections, with the globe, etc., etc. And those would be, at best, just very temporary knee-jerk reactions for us. How long before we see a sustainable earnings recovery kick in?
So the earnings actually are not so bad. The one area where the earnings have disappointed are in the consumer space. So there you are seeing a slow demand, and there you are seeing some discomfort with the valuations, given that valuations were already very stretched. And the earnings growth has been coming off over in recent quarters, but we were hoping to see a revival as a marketplace on the whole. But if I zoom out and I think about it, I don't think any of the financials have disappointed. Maybe one or two banks here and there have disappointed, but financials have delivered in line with earnings. A lot of the manufacturing companies have delivered in line with earnings, earnings in line with expectations. It is the consumer facing sector which is facing a problem, and there you have two parts to it: the consumer staples, which are hurting because of poor incomes in the rural areas, and you have the consumer discretionary, which is probably hurting because of the tightness in the NBFC system. So there are solutions to both, and I don't think it's a lost cause. So I am actually not so worried about earnings, because the area where the earnings are lagging is fairly concentrated. It's not across the board softness in earnings that we are seeing. And the pockets where we expected a recovery, which is essentially the financials, the recovery is taking place. So my sense is that I'm okay with overall earnings environment and earnings outlook, with some moderation in consumer names. But I think what I am trying to figure out is what are the policy solutions that become available to address both areas of demand where there is a slowdown, the consumer staples demand as well as the consumer discretionary demand. And I've tried to outline what my thoughts are. Let's see what happens.
Election is being widely discussed today. A month from now it will be discussed, and 6 months from now it will be forgotten. And that's what market history has told us. I'm going to keep the election aside,
yes,
and talk about 3-4 stocks, or maybe 1 or 2 themes where you're saying, look, it doesn't matter to me whether it is BJP stroke NDA or whether it is Congress stroke Mahagathbandhan. I'm going to buy these stocks, and if they fall on the election day or after the election day by 5%, I'll buy them more.
So, we are unfortunately constrained from taking names. So the only broad earnings recovery that is visible today is in the financial sector. So I think that is one area where we feel reasonably positive about, especially the large banks. I think, there are the small caps and the mid caps where the correction has been severe over the last 1.5 years, where stock prices in some cases are down 50–60%. But where the earnings outlook has not moderated by more than 10 or 20% compared to where we were 1.5 years ago. So in effect, valuations have corrected by 30 or 40%. We see a lot of opportunities. So it's a very bottom-up scenario where you have to look at individual stocks and individual ideas. Test your thesis, what the investment thesis is, what the earnings outlook for that particular company is, and where the valuations are relative to the stock's own history or relative to the peers. And I think these are the pockets of opportunity that we are trying to identify. Obviously, it's not a one-size-fits-all right now. In some earlier conversations, I've said that I'm positive on pharmaceutical companies as well, where there are some macro worries relating to the lawsuit that was recently brought about in the US. So I think one has to be a little more selective there as well, but that is an area where I see there is an opportunity, though one has to be again very careful about the kind of non-anticipated liabilities that might arise as a result of this lawsuit. But not every company is named in that lawsuit. So for companies that are not named there, are there some opportunities out there? I would think so. Second tier, IT has again started to look better from a valuations perspective. So that's the third area where I see some opportunity. But bottom up stock selection is, I think, the key, and that's how the Indian market has always been. I mean, it's less about broad market direction. It's more about bottom up stock picking.
All right, Ashwini, thank you so much for joining us today and sharing your views with us. Good chatting with you.
Thank you for having me.